All right, welcome everyone to this month's FERC Professionals Group. My name is Drew Franklin, and I work here leading the marketing team here at H Data. And we are excited. We've got an awesome presentation planned for you today. We've got an awesome crowd. I'm going to give just a few more seconds for people to come in. Great response for this month's outreach. And got some feedback there. And so we are looking forward to this presentation featuring Rogers Herndon from Alvarez, Marsal, and I will get into a little bit of an introduction of that here shortly. So let's go ahead into the part of this presentation. What are we expecting today? Today's program, I just again want to welcome everyone. We'll get into a little bit of an insider update from what happened at the NARUC Winter Policy Summit in Washington, D.C. last week, and our conversations and insights we were able to pull from there. And then looking into what does our presentation from transform to transition from Rogers and our very own Luke Ashton, who will be co-piloting this presentation, if you will. We've got plenty of time for questions and answers time, and even an open discussion that's going to take place throughout the presentation. And I will highlight, if you are looking to where you can put your questions, feel free to look to the right-hand side of this presentation window. You'll be able to see a chat box. Feel free to drop your questions into this chat box on the right-hand side. So feel free to drop questions here. And we will go ahead and start with a little bit of an introduction. So again, welcome to this month's FERC Professionals Group. This is an exciting time. I mentioned earlier that we did get an awesome response. We've got so many attendees that are coming in great. It is wonderful to see month over month, just not only the level of programming from our speakers and presenters, but just also the quality of attendees that are coming. These are folks from all over the country, from coast to coast, whether it's a regulatory commissions, we've seen research in academia, we've seen regulated utilities and consulting efforts and everything in between. So we're excited to see the mix and the diverse nature of our audience. So again, welcome to this month's presentation. If this is your first time to the FERC Professionals Group, it's an exciting time because right now we're in this beautiful season of just like revamping and being able to really add value to our community group. And we truly exist as a community of FERC reporting professionals interested in solutions for producing and consuming financial and operational data. As a mouthful, basically to say we want to help digitize the public and private sectors. And that's the mission behind H Data. And we believe we're able to add value to our FERC Professionals Group. And this is a wonderful place. It's an open forum for us to network with each other, get to know each other, ask those questions, and our hope is the goal of this conversation is that we are engaging in a network opportunity where you feel a safe environment to ask those questions and be able to learn something and have some nice takeaways today. I will plug our LinkedIn group. If you are active on LinkedIn or you have a way to be on LinkedIn, we would invite you, please join us in our FERC Professionals community group. You can search FERC Professionals Group and we'll be able to make sure and get you added there. It's a great way we distribute content there. There's some polling. There's a lot of conversations that take place, and it's really an engaged community. So we're excited to have you there and join us. And it's a great feedback loop as well, somewhere where we're able to not only find presenters, but also different topics, maybe even just have an understanding conversation. I know recently the FERC has announced different data formats for different FERC forms, and we've been able to get some poll audience on understanding how that may impact your business. And I think we'll do a little bit deeper dive on that during Roger's presentation. And I'll pause right here and I'll kind of take over a little bit of what happened from our insider update. And we've got Jeff Press, our Chief Revenue Officer. I'm going to fill in for Jeff, but I do want to give Jeff kudos on joining our team last month and leading the charge at the NARUC Winter Policy Summit in DC. And we just had an incredible response. There were several hundred attendees, and we got so many good conversations and insights from that event. And there were three key takeaways that we found from that event. Number one was we continue to receive that validation through this access of data from the FERC. And that's from forms 1, 2, and beyond those different FERC forms. And it's more critical than ever for rate case analysis, but even for benchmarking. And number two was we know there's tools that can do this for analysis, but really tying all those tools back to the data seamlessly, whether that's compliance and business intelligence, being able to take action with that data. We again, one of those things that it's one of those paramount items that HData provides, and that's something that we saw as a validation coming out of NARUC, whether that's policy questions or just doing more research through transmissions, so on and so forth. And the last thing was we know regulators and regulated utilities are interested in the data, but it doesn't stop there. We had some incredible, insightful conversations outside of your normal regulatory commissions and your regulated utilities. Again, these were consultants, law firms, and even something that we didn't expect, but now we have really engaged with the academia world. We've had a lot of research coming from higher ed that we've been able to engage with using the data, using the platform in a way that's never been done before. And if you want to hear a little bit more deep dive information on what Jeff was able to share from that event, feel free to hit the LinkedIn link I just shared in the chat, and we'll be able to, you can see a little bit more color commentary from Jeff. So with that, speaking of access to information, we want to just drop a little bit of a way you can access that through the HData platform, and something that we launched back in the summer, and something we've been building on month over month, it feels like, through our HData library. And now we've opened it up to different parts of the business intelligence platform by going to app.hdata.us/signup. And you can have free access today to our HData platform by being able to access 10 plus years of annual and quarterly FERC reports. We have some advanced search capabilities. Let's say you wanted to look specifically for Georgia Power, the year of 2021, FERC Form 1, and you wanted to see all the FERC Form 1s of Georgia Power. But also there's a document comparison tool in there. You wanted to see year over year, maybe comparison side by side, and be able to export some of that information. And you can have that straight at your fingertips for free. And one of those items that we launched last month was our O&M expense analysis. And so again, you go inside the platform, go into a part of our business intelligence suite, and look at the O&M expense analysis for electric, gas, and oil. And these are three items that, again, are totally at your fingertips by signing up today. And it's something that's been one of those responses that was at NARUC, for example, was just like, oh, wow, like, are you for real? Like, I can have access to this today. And it's just one of those things we continue to get those conversations, and it's like, yes, absolutely. And so feel free to jump into that. It's something we're very proud of, and something that we're excited to partner with the industry on, again, getting to that access of data. And so right now, I want to transition quickly into a little bit of our featured speaker today. We've got Rogers Herndon, and he is the managing director at Alvarez Marsal's energy practice based in Houston. He specializes in corporate transformations, cash flow improvement, M&A planning. The list goes on and on. He's a strategic advisor. He's been in the energy industry for quite some time, serving in executive level roles. And we are excited to have Rogers present on the transform to transition, an inflection point for U.S. utilities. And one item that when we heard this topic and we read the paper, it was something that just kind of just stood out to us. It hit us between the eyes of just like, yes, like this makes total sense in a way that we've probably never been able to see that before. And one of those items that I'm excited about how we're able to interact with FERC data like never before through the XBRL mandate. But I believe Rogers has a unique perspective on how he's able to use FERC data and put that research into the paper. And so without further ado, I want to introduce Rogers Herndon. And Rogers, I'm going to bring you on stage to the FERC Professionals Group. Glad to have you today.
Thank you, Drew. Really appreciate it. Let me just so I can make sure everybody can see my screen, can you see the presentation I have up now? Okay, good. Well, look, welcome everybody. Take two here. Just want to talk through what transform to transition means, the data aspect of it. And thanks for having me. Just kind of go through a quick little narrative. You know what we really saw about a year ago. We started digging into the changing landscape. That changing landscape was much more inflationary driven. We had a change in the yield curve. Um, things that started to maybe impact affordability like they haven't over the last decade. We looked at utility growth objectives. We looked at capex commitments that would be increasing with energy transition, and really, in the Alvarez and Marsal fashion, we wanted to understand whether the trajectory that has been intact for the last decade or so is still intact going forward, and what kind of flexibility is a utility going to have in this new environment when they're balancing safety and reliability, shift to a clean energy transition, and then maintaining affordability, all while meeting growth objectives. That's financial growth objectives, and rate-based growth objectives within the constraints of cash flow and balance sheet. And where we went straight to is we wanted to kind of just where the rubber hits the road. We want to look at operating cash flow relative to cash outflows, dividends, and capex. We started to look at that, and what we found was pretty interesting. It was a pretty tight relationship, pretty tight ratio, and I'll just put it in context. When cash flow, operating cash flow isn't there, or meet dividends and capex, and in the case of a utility, we think about it as zero point 0.5 capex, because pure utilities are generally capitalized similarly at about 50-50 debt to equity. So every dollar of capex is generally going to be funded by about 50 cents of debt, 50% of debt. And so when that equation gets a little tight, when there's a deficiency over the last several years, it hasn't, equity issuances haven't been that problematic. And kind of the backdrop is, utilities fund a pretty nice dividend. And relative to, the alternatives, the low treasury yields, if you needed to issue a little equity to fund a dividend, it really wasn't that problematic. And so the data we saw implied that there was pretty, shrinking flexibility in this changing landscape. And one of the things that we wanted to look at is was this applicable to just one utility or a group of utilities? And what we found is it was a group of utilities. It was more than just a single or isolated situation. And then what we did is we wanted to go back and look at, how is this ratio behaved over time? And this was really kind of the aha moment for us. And what you're seeing here is this is a group of utility holdcos that we had to look at, because the FERC Form 1 data at the opco level really doesn't give you great visibility and consistency around dividends. It's good in terms of OCF and capex, but what we saw over this last decade was that ratio of OCF to divs plus 0.5 capex reduced from kind of 1.6, really nice coverage, to, as you can see, around 21, the median starts to dip below 1, and that's okay as long as you are living in the environment that we have been in the last decade. And again, that environment is reducing fuel, reducing purchase power, reducing cost of capital. And in that type of environment, the affordability piece of the equation is very much manageable. And so, our thoughts move to, well, how is this equation going to be adjusted going forward? What needs to change? What might need to change? Before we go there, we started to dissect this equation down to a little bit deeper level. And we saw some pretty interesting things. We saw, capex relative to PP&E. That's one ratio we look at. Pretty steady. That's the top right of the screen. We saw cash flow as it relates to revenue, kind of flat to down. I'm not gonna read too much into kind of 2021 with COVID, but not really a favorable ratio there in the top left. We saw over the past decade capex to revenue increasing. We expect that to continue to increase based on growth objectives. And then we saw on the bottom right dividends relative to revenue increasing. So, again, this trend really started to, I'd say, concern us in the near term with the changing landscape as it relates to the flexibility for a utility to meet growth objectives, the financial growth objectives, PPE growth objectives, relative to cash flow. And I think a backdrop of this is, what you're seeing right now is you're seeing a significant number of rate cases. You're seeing a significant number of significant level of increased rates in those rate cases. And, I think what we expect to see on the margin is generally we're going to see PUC pushback on that. And that pushback is going to come around the impact of affordability. And so our transform to transition, what it really gets to is what are the levers that utilities can do to pivot and transform their operations as we really move out of the past decade environment into a less deflationary environment, a higher cost of capital environment, and make that pivot at a time period when, as an industry, we've really gotten very comfortable. That's what this ratio shows, is we really got very comfortable with the macro backdrop. And the implication there is our flexibility has declined. And so one of the things that we started to look at, I'm going to try to shift my screen here to another one. Hopefully this shift occurred here to this. This is part of the paper we wrote. And what this is, another piece of data, and I think Luke will talk to this. We went and looked at the expense profile for utilities. And this was very interesting. Maybe a lot of people in the industry, are very well of this, but when we looked across a number of opcos, what we found is that the non-return based spend, that is the amount of expense that the expenses that utilities make that they do not make a return on. These are pass-through expenses. This is fuel, this is purchase power, this is O&M, plant O&M, this is T&D O&M, and this is A&G and customer spend and non-federal related income tax. That represents about 60% of a utility's revenue profile, or what I'll call the rate stack. The remaining that's return-based spend. That's depreciation, amortization, and on top of that's your margin. And so here's the implication. In near term, the implication is if cash flows lag, they don't keep up with these affordability linked expenses. Well, what takes the swing is that margin. What takes the swing is that OCF. And so we need to do things in the near term to start to focus on efficiency, start to focus on value-driven decision-making versus budget-driven decision-making versus task-driven models that may exist inside a utility. But over the long term, this makeup needs to change, because as we think about the transition, okay, this is the transform to transition. We think about the transition, utilities, I'll speak generically. Growth targets are along these lines: 5 to 8% EPS growth, equivalent dividend growth. That's going to be accomplished on the back of, call it, 5 to 7%, 8% net growth in rate base or PPE. Well, look, in order to do that, we need to shift these non-return based spend items down, shift them, let's say from 60%, let's get them down to 50 and 40, to create headroom, rate headroom, to wedge that depreciation and amortization in, that's that rate base growth. And what we also need to do is take this variable cost, this variable spend on the left-hand side of this chart, and shift it over into value-based, return-based part of the balance sheet. And so, with that, that's primarily the thesis behind our transform to transition deck. And what we've mapped out here is really how can we marry these financial performance objectives with the strategic objectives, and do that in a way that's really a value-driven performance model at the utility. And I'm just going to end with this, and I want to hand it over to Luke to show the data, or to show some of the H data that supports this. But when you think about value-driven performance model, I'd just like to pose this question, or challenge. If you suspend disbelief and kind of redraw the utility model, and let's just say affordability was the number one binding constraint, you can't raise rates. If you can't raise rates, what are the levers that you will pull to manage according to those growth objectives? And I'll tell you, if you think about O&M spend, every dollar of O&M spend that we can take out of the rate stack, it's a pass-through dollar. Every dollar I spend, the ratepayer is going to pay that dollar. Every dollar I can take out, I can convert that, or I can spend the equivalent of $5 to $8. It depends on your depreciation schedule primarily. I can take $1 of O&M out, which is, again, fuel, purchase power, plant O&M, and I can convert that into $5 to $8 of capital. And so this starts to bring a capital efficiency mindset into the way a utility operates and the way a utility thinks. It really brings a competitive mindset. And I think, that exists at the senior levels. As you move and cascade into the organization, what we see is a shift or a transformation that we would like to see and help happen, is that shift towards value-driven decision making that links up to these growth objectives, that understands this trade-off between non-return based spend and return-based spend. And and there's a playbook that we can run to do that. But I think, Luke, what I'd like to talk about is the power of the data. We could not dig into this. Well, we did. I mean, we dug into it with Excel spreadsheets. I mean, it took hundreds and hundreds, if not thousands of hours to really dig into this data. And it's easy to dig into 1 year data. But the real value, and the value that H data brings, is our ability to look at this trend. If we just looked at 2021, we could have accepted this ratio as just, that's the way it is. That's the way it's always been. But our ability to go back in time and to look at that data back 10 years, this really told us the story that we were looking for, the values in the trend. And, we looked at the same ratio of that non-return based spend, that 60% ratio. We looked at that over time. And I'll be honest, over time, over the last decade, that amount has come down. It's come down from about 75% to just under 60%. And it's come down on the back of lower fuel and purchase power primarily. T&D O&M's been moving up. Expect that to continue to move up. But so that ratio of non-return based spend has come down. And our concern here and our focus on transform to transition is that's about to change. That non-return based spend that's declined on the back of fuel and purchase power, that is going to change in 22. And as the year comes to a close in 22 and FERC drops their Form 1 data, I think the data is going to play itself out. And so, Luke, I'd love to get your perspective on this.
Yeah, for sure. Thanks, Rogers. And I definitely kind of, when we were working on this analysis, yeah, when you showed me that spreadsheet here, if you're one of our current customers, this is probably a very familiar aspect of like you have this massive spreadsheet that you're having to manage, and then you're only getting snapshots of data. But the thing that we're trying to provide here is that trend, as you're talking about, being able to see all the data within context without the silo of a single year's worth of data. So, Drew, if you don't mind bringing up my deck here. So I just picked a couple companies here, which, I don't want to call out any particular company, so of course I anonymized it a bit. But we're looking at the top. I picked a few different companies, the top 10 utilities by 21 operating revenues. So these are the 10 largest utilities by operating revenue in the United States. And we're looking at particular items here as a proportion of operating revenues. So as we're looking at this trend here, we're going between 2010, 2021. And as we can see with this company here, they were above 60% of their operating revenue proportion was being assigned to non-return expenses. So we can easily see here the kind of in this lime green piece of the bar here, that is fuel as a percent of operating revenue. So as we're seeing kind of this crunch down on fuel proportionally to operating revenue, and their purchase power has been fairly stable, but when we're seeing increases in, say, T&D, actually, I did want to bring a question for you, Rogers, maybe a little bit after this, is how can we kind of take the analysis or the lens that you're presenting here within your research and apply it to specifically transmission? Because I know the FERC has been heavily focused on transmission development, especially in the near future, with their notice of proposed rulemaking that they released last year. And then also, if you guys haven't seen the article that Rogers and his team made, you can go on the Alvarez and Marsal website, look up transition, that report there. And the second point you kind of put in that research there is sourcing capital to fund increasing infrastructure investments. Especially, you're going to have to be creative in how you're sourcing that capital. So as we're seeing increases in the T&D O&M and that non-return aspect of it, how are companies going to try to keep that low relative to their operating revenue while also still trying to increase investment within transmission, increase investment in distribution, of course, getting the OPEX out of it as they build this out and actually starts being used and useful for the ratepayers. So we're seeing this an example of one company. If we go to a second company, we're seeing a very similar story, a crunch on the fuel as a percent of operating revenue, purchase power being fairly stable. At least in this case, they actually saw an increase in purchase power, but they're still keeping it below 60% of operating revenue. So I'll kind of turn it back to you, Rogers, and maybe you can hit on those couple points I was asking about with the transmission as well as capital investment.
Yeah. Great. Can you guys hear me?
Mm-hmm.
Yeah. Well, look, I think, we need to make room for more transmission investment. And the chart that you're showing there, Luke, is great. I mean, it shows the trend down. It shows what's allowed this trend of non-return based spend to shrink. Again, it's that kind of purchase power, that fuel, that deflationary. We look across a lot of companies. We've seen A&G decline a bit, but we really in the go forward environment, I think we're going to need to see transmission spend, distribution spend, kind of take a bigger chunk of O&M, take a bigger chunk of that, but also on the CapEx side. We're going to need to see the CapEx side, the depreciation and amortization around, T&D spend to facilitate the energy transition. We will need to see that ramp up for sure. And I think, what we're trying to portray here is that in everyday decision making across the utility, how do we think about capital efficiency? How can we think about opportunities to shift from OPEX to CAPEX? Then the other side of the equation is what can we do to increase billing determinants? What can we do with our OPEX spend to accelerate electrification? Give you example, EV adoption. EV adoption, what can a utility do to embrace EV adoption? How about embrace EV adoption in conjunction with residential batteries? Let's think about that. Without residential batteries in conjunction with EV electrification, it's likely going to require pretty significant upgrades at the distribution level system to facilitate that electrification. So let's just rethink some of these strategies so that we can grow demand, grow throughputs, shift that variable OPEX, and really make room in that rate stack. Again, it's make room for that T&D spend, that T&D capital investment that you're talking about, Luke.
Mm-hmm. Yeah, when I was at the neighbor conference, I also went there this past week in DC because I'm based in the DC area, so it was probably the shortest commute I've ever had for work. But when we were at the neighbor conference, it's not just the FERC that's focusing on transmission, it's the state utility commissions. They're also heavily focused on it. And I definitely recall that DERs were the main crux of almost every conversation that they're having at the conference here. So when we're talking about like those residential batteries, they were immediately talking about like products like the Tesla Powerwall. It's a good example of having those residential batteries there. And how do you actually, from a regulator side, and of course this will end up impacting the companies themselves, the utilities, but how do you actually design rate cases or incentives within the rates to actually encourage that development on the customer side? Because customers, unless you have a specific program that's subsidizing the public, most of the customers are buying these products themselves. They're buying the Tesla Powerwall, they're buying the solar panels. So how do you design rates to both incentivize the customers for building this infrastructure in some cases, and then also making sure that companies are still earning a profitable rate so they can actually keep the company functioning? So that was kind of the main conversations that I was seeing at the neighbor conference, and I got asked about it all the time when people would come up to our booth. So it's really interesting to see how this is transitioning. I'm really, really excited for the 2022 data coming out within the next couple months, and especially when we noticed when we're doing this analysis, Rogers, on kind of that A&G shrinking. I'm going to be really curious how it's going to look for 2022, because when I talk with a lot of our current utility customers, they're noting that, it's almost every company seeing some kind of, not layoff, but a lot of people just retiring, and then they're not bringing in staff to kind of replace them. And it could be because of those budgetary constraints, especially with the macroeconomic pressures that we're seeing nationally with inflation, with the war in Ukraine, and a lot of other external factors that they just can't control for. We need to be innovative in how we're actually bringing products to market to actually empower the analysts that may still be there and making their work increase like tenfold or 100-fold, and making sure that they're actually saving them time and effort. So I think that kind of A&G decreases. I'm really curious to see how that's going to actually impact the 2022 data. Again, I'm also expecting that we're going to see an increase in T&D. Like, I'm really, really excited for this data, if you can't tell. I'm really, really excited for April to roll around and see what we actually end up getting.
Yeah, me too. And what you're talking about is, embracing the value-driven mentality to pivot, to transform, to deal with this shift in this macro landscape. And I just want to make one point very clear: is that, I'm personally very bullish on the outlook for utilities. I think we've set ourselves up as an industry for a tough few years here to transform. But there is a really bright outlook on the backside. And I'm talking, 3 to 5 years, when we really start seeing the benefits of electrification. And so, I want to make that clear. This is a huge opportunity. I think there is going to be some, limited flexibility. And look, the trap, I'll be really honest, the trap we're trying to keep utilities out of or minimize is maintain, to the extent you can, maintain your growth trajectory. Minimize any equity issuance. That's really the last source of capital you're going to want to go to in this environment because of the changing yield curve and the dividend profile relative to alternatives. Probably a little bit of a different conversation, but I think the executive team at utilities really get this. They get this. There's been about a 50% turnover at utility executive teams. It's a great time to kind of dig in and think about this value-driven, capital efficiency-based approach, and really set yourself up, for that really positive outlook that we see with utilities and the energy transition. And the last thing is, this is not about, we're not here preaching shut fossil down tomorrow, shut fuel down tomorrow and shift it all to renewables. We know that is not that's not realistic, but there are things you can do to accelerate. There are things you can do with things like build, transfer, renewable projects relative to versus PPAs. And the IRA is a great enabler. Utilities should be the experts on IRA. And so with that, maybe I'll turn it back to you, Luke and Drew, and maybe take a question or two.
Yeah, do we have any questions in the chat, Drew?
Yeah, I'm looking at the chat right now. We've got one coming in. I'm going to go ahead and ask this question because it was kind of top of mind for me. Is we mentioned earlier, how does instant access to utility regulatory data change our ability to help utilities reset that strategic growth narrative? I think you touched on it a little bit. I'd love to kind of hear your take on that.
Well, I think it's just the data's been there. It's been in a really difficult format, very difficult to analyze, to the point where people just didn't do it. I mean, I'll be honest. I mean, the hours that it took to get through 10 years of data and 10 years of data, and to get your universe or your sample set to the right group is difficult. We want to look at electric only. We want to look at a certain size, let's say. And so this data, creates transparency. I think it creates transparency inside utilities, and you can look across utilities, and also for the commissions and the regulators. And I just think, the attention to this data is going to drive change. It will drive the transformation, Drew. And look, I'm thankful that H-Data has given us this platform that takes, what took hundreds and hundreds of hours to, tens of hours to analyze this data.
Wow. Well said. Thank you for that. And there's another question that came in from Hudson Hollister. And what does the next generation of utility leadership look like? And the follow-up question to that is, can they handle the coming fiscal crunch or challenges you've described?
It's a great question. Thank you, Hudson. I mean, look, I sit back and I look at what's happened, and maybe a little cynical, but with all the turnover at leadership at the CEO level, I have to say, I'm not sure that's a coincidence. If I were sitting in the seat and had that backdrop over the last decade that I was able to manage through with affordability and growth, and I saw what was about to hit me, I might rethink my next chapter as well. And so, look, it's going to be tough. But I think the great thing is we do have new leadership coming in. I know several of them, and they get it. They get this capital efficiency. They get this. It's all happening, I think, at the right time. This is a huge opportunity. The IRA is an opportunity. The shift to energy transition, this shift away from high variable, non-return based OPEX to return based spend, it's always been in the background. This shift in cascading your growth objectives into your organization to go from budget driven and task driven to value driven. These are leadership philosophies that have lived outside of the world of a regulated utility model, and it's time to adopt this value driven capital efficiency philosophy, kind of a competitive driven model, and rethink about what it means to win for a utility. And so, yeah, Hudson, I think they're going to get there, and I think it's really exciting.
I actually have a question on the analysis that we've been doing so far. We focus a lot on utilities that are kind of like the full package. They're doing generation, they're doing transmission, they're doing distribution. I'm wondering if you see any differences or changes in how, say, a company that only goes into transmission distribution, or only generation, or only transmission, like an ITC or an ATC, are they having similar pressures, even if they are only operating in one aspect of the industry relative to, say, like PG&E that's kind of doing the full spectrum?
Luke, this is a great question. Wow. I would say the integrated utilities have that full, what you're showing there on your graph. They have the full control over that value chain, the fuel coming in, the purchase power, the shift. So I'd say they have more levers to manage affordability to a degree, and there can be a lot of debate around this. And if you're just a T&D, where truly your power prices are passed through, man, that's going to be an interesting model to see play out, because that power price is really an unregulated component. And when it gets to affordability, the commissions are going to have a hard time pointing to the utilities to say, hey, what can you do to control that? So it's a great point. It's probably worth another forum and debate, and to get some smart minds in a room and talk about that. But it's something that we're definitely thinking about. But it doesn't change. It doesn't change the transform to transition levers whatsoever in our mind.
All right, great. And I think one last question, but as we kind of end it here, is when we're talking about affordability, how does the transform the transmission model take into account customer affordability given the macro landscape?
Yeah, to me, it's all about maintaining customer affordability and living within your balance sheet and cash flow constraints. Those are kind of the real drivers of this transformation. And I have to say, Luke, affordability. Look at your graph there. That's what's behind that graph, and what's a driver of that graph is that affordability hasn't been a big issue over the last decade. And all of a sudden, at the same time, we've got this call on capital with energy transition. Not only are we having that, which is the return-based side of the equation, but now we're having this non-return-based side of the equation rear its ugly head, with volatility around power and fuel prices, and just outright increases. And so, this is affordability and balance sheet and cash flow are the call to action, case for change for our transform to transition model.
That's awesome. Rogers, Luke, thank y'all so much. And I'm not seeing any other questions. A lot of really good, just good questions, great presentation, a lot of insights and kind of data to digest. But Rogers, Luke, thank y'all so much for presenting. And this was a lot of value. And we'll make sure to cut this up and get a nice recording out to those who are able to attend this presentation. And then we'll kind of jump into the next part of our presentation. Rogers, thanks again.
Thank
you. All right, so let's move into, you may have asked yourself, okay, I see the material that Rogers presented. I see the graphs that Luke was able to present to back up the data that Rogers presented. It's like, how can I then potentially see or even do a test drive of this data? Well, we'd love to give you something, and that's just an opportunity that you can go to our website, hdata.us, look under the resources tab, and then click on the energy scorecard. And what is an energy scorecard? It's just an easy way where you can have an opportunity to see some high level overview, whether that's financial data, that's information coming off the different FERC forms that we're able to aggregate and put that in a nice visual format. You can do that through our energy scorecard area. And now, if you're looking for a customized option, I use an example all the time. Maybe if you're Georgia Public Service Commission or the Vermont Public Utilities Commission, and you would like to get maybe a state customized report, all of the regulated utilities that are in your purview. And feel free to fill out the form that's on that page, or just click around and take a test drive on the different cards that we have available there on the energy scorecard page under the resources tab at hdata.us. And with that, I just want to make sure that everyone was aware that in March, we do have an upcoming FERC Professionals group where we will feature Mary Mouchette, who is the former SVP and CIO at Colonial Pipeline. And she's going to present on a lot of digital transformation efforts that she led, not only at Colonial Pipeline, but her expertise within the regulated energy industry, leading those digital transformation efforts and the adoption of new technology, which you've probably seen the numbers and seen a lot of the information. Maybe the regulated energy industry is slow to adopt new technologies, but there are others who are on the bleeding edge, if you will, of new technologies. And Marie's going to walk through those different efforts she led during her time at Colonial Pipeline. So we're excited to have her next month and be on the lookout for more information of that. And with that, I would love to say thank you. Thank you all for joining us, and thank you for some of those rejoining us. And we look forward to seeing you in March. Thank you, and have a great day.